Hey guys, and welcome to Money Talks News, the podcast. In this episode, we're predicting what's going to happen to your money in 2024. Israel, Ukraine, a presidential election, inflation, possible recession. There's a lot going on that could affect the global economy as well as your personal economy. It's always dangerous to make predictions, but we're going to do it anyway, as we have for decades here at Money Talks News. Today, we're going to focus on three main areas: the stock market, the housing market, and interest rates. Now, more than likely, you've got a dog in at least one of these fights, right? So in addition to predicting what's ahead, we're also going to make suggestions on what you should be doing now to prepare for that. I'm Stacey Johnson, as usual. My co-host will be financial journalist Miranda Marquardt. Hello, Miranda. I've missed you.
Hey, Stacey. I'm excited to start this year off right with all of our wrong predictions. Let's do this.
They're not going to be wrong. Listening in and sometimes contributing is our producer and novice investor, Aaron Freeman. Hello, Aaron.
I just stopped predicting. I'm done.
I don't blame you. We've also got a couple of guests here with us today. The first is Mark Lieberman, CFA, an independent advisor with Shorepine Wealth Management. Welcome to the show, Mark.
Thank you, guys. Very excited to be here. Thanks for having me.
You're quite welcome. And we also have friend of the show, Pam Kruger, who just will not get off of our airwaves. She's with us all the time. Hey, Pam.
Hi.
Pam is from Wealth Ramp, and what she does is hook people up with people like Mark. So anyway, more on that later. But as we start the show, remember this: we do not give you financial advice. Why? Because we don't know you, so we can't do that. So make sure to do your own research and consult your own experts before acting on anything you learn here. And now, guys, we can't be sued. Let's dive in. Okay, let's start with the stock market. Mark, I know exactly what the stock market's going to do in 2024, but I want to know what you think.
Yeah, I'd love for you to tell me exactly what it's going to do in 2024. I see a market right now that still has a lot of excess from the pandemic liquidity that we all got to get to work off. And I think that that's going to come out in earnings. As we all know, earnings is what really drives the stock market. You look at just fourth quarter earnings, at the beginning of September, people were calling for about an 8% growth in fourth quarter earnings. Now that we're almost through the fourth quarter, it looks like it's coming in at about 3%. So I think that that's going to be what you're going to see for most of 2024 is expectations a little bit above where reality is. You still have some job losses to be taken out with, the pandemic era. I call it the pandemic era fattening of our corporations. They have to slim up a little bit. And so you're going to see some job losses and you're going to start seeing a little bit of a cutback in earnings. That does not denote, we're going into this terrible linear recession where you're going to start seeing, everybody and your brother losing their jobs and people on the street trying to sell apples. But you certainly are going to start seeing corporations cutting, people cut back on spending, and recession-like environment is what I'm calling it. Not full-blown recession, but, a light recession during 2024. That doesn't mean the market can't grow through that. So what I'm thinking is you're going to see somewhere between a 0 to 5% growth. If we're on 4,700, around 4,700 on the S&P 500 right now, maybe you see 5,000 by the end of 2024, but you might see it go well below 4,500 before it gets there. So volatility, a lot of excesses still to work off, but corporations are strong. The Magnificent Seven stocks have wonderful balance sheets, and I think the U.S. economy can weather the storm, whatever that storm may be.
So you're looking at, now we're at 4,700. And by the way, folks, for those listening, we're recording this on December the 14th of 2023. We usually do stuff that's evergreen, but this obviously we're going to tell you where we're at. And so the S&P 500 is at 4,700 approximately. Now, Mark's calling for 5,000, which would be 8%-ish, 7-8%?
About 6%.
About 6%. Okay. Yeah. Now, I'm going to do what I always do, which is try to make people uncomfortable. And I'm going to ask everybody here. Let me say this, too. I was looking at notes before this podcast. The most bearish Wall Street S&P forecast I could find was from J.P. Morgan. And they said end of 24, it's 4,200 on the S&P 500. That's 300 points less than we are right now in December of 2023. The highest forecast I saw was Capital Economics at 5,500. So that would be a huge gain from where we are now. Almost 1,000 points, 800 points. So now let's go around and talk to our panelists, and everybody's going to take a stab at where they think that the S&P 500 is going to be on December 31st, 2024. Aaron, we're going to go alphabetically.
All right.
You've got two A's at the first beginning of your name.
I actually just recently watched Jamie Dimon, so I think I'm going to go with him because this guy, banks the world, and he's got some insights. So I'm going with him, 42.
Oh, okay. Now, you don't have to pick one of these two things. You can pick anything in between, too. But you think the market's going to fall this year?
Yeah.
Okay.
To me, Magnificent Seven here, the only thing that's held it up. And now I noticed today, if you look at the heat map of the stock market, the Magnificent Seven are down, and now all the other little guys are green. So everybody's just playing a game.
Okay. Aaron's not a big stock guy.
I'm so impressed.
Okay, Miranda, you're next alphabetically. Where's the market going to end up?
So, I'm not gonna. Well, gosh, I hate this because the thing is, we've been kind of due for a better correction. I don't really count the 2020 stuff due to COVID as a true correction for the market or a true crash for the market because it was over pretty quick. It was kind of a blippy blip, and then, and 2022 was a little bit bleak. 2022 was a little bit bleak, but here's the thing. So as of December 11th, the S&P 500 was up right around 20% on the year. And if you look historically speaking, the year before an election year is the S&P 500 has usually a 17% average gain in the year prior to an election. And that's according to U.S. News and World Report. And then they're also saying that since 1952, during a U.S. presidential election year, you're seeing a 7% gain in the market. So, so you're looking at this, you're going, okay, so if we go with historical predictions, then we should be seeing a gain in the market. But also if we're looking at the fact that, we've been due for a real crash, I personally think, for a while, and we haven't really had a true, sustained downturn for a hot minute. But, U.S. monetary policy is entirely focused on propping up the stock market. So who knows when we'll have a downturn because even though we probably should, according to economic cycle theories, our entire monetary policy. Nobody wants to have a market crash during a presidential year, guys. Nobody wants to be responsible for that, and U.S. monetary policy often reflects that.
Now, here's something I used to say when I did television news. You didn't answer my damn question. Where do you think the S&P 500 is going to
brutal.
I don't know. I never know because whatever I think is going to happen never does. I'm waiting for a real crash. I am waiting for this mother to drop below 4,000.
Why don't you just say 4,700 and be
okay? Let's say.
I might jump in here, Miranda.
Do it, Mark. Save me, Mark.
I'm not going to save you, but to your point, I think the market agrees with your assessment that the Federal Reserve is gung-ho on keeping this market up. When the Federal Reserve came out yesterday and talked about, change one word in their statement to, now about how things are going to look, and the dot plot change to include, potentially 3 rate cuts in 2024. If you looked at the futures immediately called, and those 3 rate cuts were 75 basis points. The Fed futures immediately called for 140 basis points of rate cuts. So the market is ahead of the Fed in saying this Fed is going to do everything it takes to keep this market afloat.
Yeah. By the way, let me intercede here and tell you guys a little story. Every year for 15 years as a television news reporter about this time of year, and Aaron was with me for the last 10 or so, right, Aaron?
Yeah.
We'd go out and stand on a street corner and stop whoever would stop and say, what do you think is going to happen to stocks, housing, and interest rates next year? We did that. I did it every year for 15 years, and Aaron and I did it together for probably 10. And just so you know, and we would also compare that with Wall Street experts, people who get paid millions of dollars to go on television and make the same predictions. Now, let me ask you guys something. Who do you think was closer, the experts or the people on the street?
100% the people on the street.
The truth is, Mark, that it was both. I mean, sometimes the experts were going to be better, but I can tell you right now, if you can go on CNBC right now and you can say the stock market's going to go up 8% next year, because I'll tell you, that's exactly what experts do every single year. No exceptions. And so anyway,
Yeah, we have short memories. Okay, so I'll pop in really quick, and I'm going to make my answer really short.
yes,
Stock market. I say up slightly, but are we talking about literally like December 31st, 2024? Because you know what's going to happen. You can't say what's it going to do next year. Well, of course it's going to be all over the map. Of course it's going to be
no. Literally December 30. Was I not clear on my instructions? December 31st, 2024.
December 31st.
I need a number.
We will reconvene only to find that I am right. The stock market will be up 5%.
So that's pretty much not
marginal.
Far from what Mark said. A little,
I agree with
less
that.
than what
Just
Mark said.
slightly. There's no reason for it to be in my mind, there's no reason for it to end up in any other zone.
Okay. Well, I mean, these are like milquetoast responses, but the truth is that I don't disagree with any of you guys either, though. I think that we will have a lower market in the first part of 2024, and it'll probably go back up, and be a little higher at the end of next year. But you know what? That is literally the consensus, not just among us, but among the people on TV, the prognosticators. And so, you know what? That almost guarantees you that that's not what's going to happen.
We're going to be wrong. Yeah.
We'll be wrong.
Yeah. Well, we all know the stock market does whatever it needs to do to make the most number of people wrong. And it's been doing that forever.
And it does it so well.
It does do it so well. Okay.
The bond market is the real interesting one for 2024.
Yeah, we can divert there. Well, actually, let's do this. Let's go ahead and go through, because let's talk about interest rates, because that's kind of what influences bonds. But let's talk about interest rates. Now, what do you think is going to happen with interest rates? Let me set the stage. Right now, we are at 5. The Federal Reserve sets short-term interest rates, and right now their benchmark short-term rate is at 5.25 to 5.5%. And that's a 22-year high. Okay, now, what's going to happen next with interest rates? Are interest rates going to go up, down, or sideways next year, Mark?
Yeah, so while the Federal Reserve is very cognizant of what the stock market is doing, I think they also understand very well that the real estate market really drives a large portion of our economy. And so when I talk about this coming recession, if you want to call it recession light, whatever it may turn out to be, it's really kind of a rolling recession where different parts of the economy will be experiencing recession-like environments throughout the next year to year and a half. And what I'm thinking is going to happen is that, the Federal Reserve is going to bring rates back to a more normalized level once they start seeing inflation continue to tame, or at least stay. I don't think they're getting to their 2% target, but at 2.5%, they can start cutting rates, right? And putting some more liquidity back in the environment out there, so that you don't have a 30-year mortgage rate at 7.3% like you do today. At 7.3% on the mortgage rate, nothing is going to trade. At 6%, you might start getting some movement in the market and unlock that market a little bit so that the economy remains healthy. And I think that's where they're targeting things. So I think they drive rates down maybe towards the second half of the year, maybe 1 cut, 2 cut, possibly 3 cuts. I don't think we get 1.5% cut off of the rate, more like maybe 75 basis points to 1%. And so you're going to see rates slightly lower in the market than you see today.
Okay. So let me go ahead and rephrase. Right now, let's call it 5.5% is where Fed funds rate is. Okay. At the end of next year, you're saying 4.5, 4 3/4.
Somewhere around there. Sure.
Okay. And that's actually what I think too, and what I'm reading. Okay. Let's again go around the horn. Aaron?
Yeah, I have to agree with that. It's already on that downtrend. Yeah. So if everything plays out, and isn't housing like 30% of the Fed?
20% at least.
Yeah. So I think it's very important. And I thought the Fed was not supposed to give a crap about what's happening in the stock market.
And actually, I actually was going to call you out on that, Mark, because theoretically, the Fed is all about two things: keeping inflation under wraps, and also employment, keeping employment high and inflation low. That's their mandate. Now, I don't think that they're influenced by what the stock market does. Theoretically, that is true.
Yeah, but yet you see them talk in ways that drive the market. The market, of course, is going to react, and it's going to be anticipatory to what they do. But if you have a market that is getting completely crushed, that is capital that is not moving smoothly through the system, which then affects unemployment and, eventually, obviously, has somewhat of a say in deflationary environments, or at least driving inflation lower. And so, I think you're crazy to think that they don't look at the market, but I don't think it's the first thing they look at, certainly. But the housing market, I think, is very, very important.
Yes, and we're going to get to the housing market too. But before we do, Miranda's got to tell us where interest rates are going next year.
I mean, I agree with everybody that they're likely to go down. The Fed signaled 2 to 3 rate cuts, like we discussed. Like they've signaled these rate cuts.
Yeah, they basically said it.
Yeah, and and I get why, we had inflation. Part of the reason why they were raising rates was to try and get a lid on inflation and slow things down a little bit. And now that inflation has slowed, it's time to start thinking about, cutting. Because like you said, the whole idea is they have this inflation target of 2%, and then, trying to maximize employment. But there's a lot of stuff that goes into that, and a lot of things that, as Mark pointed out, sure, the stock market is outside of their purview, stated purview, but everything they say is scrutinized by the market. And as Mark pointed out earlier, futures are already pricing in this potential rate cut.
Now, Pam, where are interest rates going?
Okay, so I don't think there's a big mystery here. I don't think it's a mystery why we all agree that rates will be lower. They've already broadcast it. And the market's already reacted to it and celebrated it and so forth. So I would say that mortgage rates, I feel like mortgage rates have to get below 6.5%. And I think
they're 6.9 today.
Yeah, they've got to get down below, a year from now. They've got to be, under 6.5%, 6%-ish, because, people are, there's just so much pressure. And in this particular economy, I think, like you all have pointed out, that real estate is so important for a lot of reasons. That consumers are really stressed right now. You've been reading about, how they've really gone out on a limb, and, many of them have taken money out of their houses and their home equity and so forth. So there's a lot of reasons why this matters greatly. And so I think it will manifest itself. I'm not going to say it's going to be in mortgage rate. 30-year mortgage rate is going to be at 5% a year from now. I wish it would be, but it's safe to say it's got to be in that 6% zone.
Yeah, I think you're right. And by the way, before we leave the topic of interest rates, 2 points I want to make for our listeners. One, although the Fed has literally said they're going to drop rates 0.5 to 0.75%, remember that the Fed has also said we are data dependent. So if things change, they'll change. So this isn't a sure thing. It never is. The second point is that going back to the stock market, the reason the Fed will drop rates is because the economy is getting softer. It's getting weaker. The unemployment rate is going to go higher. And this is why, going back to stocks, that all of us here have said that the stock market may decline in the first part of next year. That's what's going to cause the Fed to start cutting rates, and that's going to hurt stocks. And correct me, any of you, if you think I'm wrong there.
No, I agree with that. I think that there needs to be something broken a little bit more. The Fed has broken the real estate market for the time being, and I think they need to break things a little bit more to get that deflationary environment. We've gotten the slowdown in inflation, but prices are still going up. And to get that deflationary environment, you need, maybe a major pullback in the market. And when I say major, 15%, 18%, something like that. And if you look at what expectations are right now, 2024 earnings expectations are for 12% growth. I just don't see that. And so that's where that's the first culprit that I would think of when you're looking at what else can they break to get this deflationary environment, get a little bit higher unemployment to get us to a good footing where you can start spurring the economy on to grow again.
Cool. Now, we're going to take a quick break. And when we come back, we're going to talk about what we think the housing market's going to do. And more importantly, we're going to come back and tell you exactly what you should be doing with your money based on our predictions. Okay, we're going to be right back after this. Okay, gang, we are back. Before we get going, though, I'm going to ask you to do me a favor. Would you do me a favor and subscribe to this podcast? It's really important because it makes us more popular and it makes us able to bring you more podcasts like this one. So if you'd like us, do something for us and share this show with your friends and subscribe. Takes you 2 seconds, really helps us. Okay, back at it, guys. Okay, so let's talk about housing, and then we'll finish up by talking about what people should be doing right now in preparation for 2024. Where do you see the housing market going? This one's tricky. What do you think, Mark?
Yes, it definitely is tricky. It's pretty much a locked up market right now, and you're not seeing a lot of trade. I live in Marin County, which is some of the most expensive real estate in the country. And even out here, you're not seeing a lot of things turn over like you were 6, 12, 18 months ago. And that's, I think, by design. The Fed wanted to lock up that market to help drive some deflationary aspects to the economy. That being said, if you have homes like around here, the average home's $1.5 million. Well, at $1.5 million, it was trading there at when rates were at 3%, when you could get a mortgage at 3%. Well, now that a mortgage is at 6 or 7 or 7.5, I think you said 6.9 today, that house should be $1 million. And you haven't seen those prices come in yet. I've seen reductions, people knocking off 50,000, people knocking off 100,000 maybe, but you haven't seen major price reductions. So something's got to give in that market to get things to move again. And it's going to be in that forced seller environment where people say, my parents passed away and we're going to sell the house and we don't care how much money we get because we want the money. Or my job is moving to Texas and I need to sell this house, right? That's the forced seller environment where you'll start seeing a little bit more price clarity, and then that'll drive other prices in the market. So I think you're going to see a drop in prices over the next season. The selling season comes this spring, and you'll start seeing some prices come back down because, if something's trading at $1.5 million at a 3% rate, at 6%, it should be $1 million to $1.2 million, right? Rough numbers. So you're going to see some price reductions, but eventually you'll see that market unlock.
And actually, I don't have, maybe one of you guys do, I don't have a expert prediction. I have my own prediction, but I don't have like an expert prediction of where the stock market, the housing market's going next year. Do you, Miranda, Pam, or Aaron?
I mean, most of the predictions are saying, the supply is going to remain somewhat low. Like we still have that kind of in there. We've got tight supply. I know here in Idaho, as of July 2023, prices were actually down like 0.86%. But Idaho is Idaho, so it's not the rest of the country. The thing that I will be interested in seeing, and I don't know where this is going to go, but I will be interested in seeing whether if mortgage rates come down and if housing becomes, home buying becomes a little bit more affordable as rates come down. But, we'll see. If the housing supply remains tight, then prices may not drop even as mortgage rates do, and it may not be as affordable as we'd like. But I want to see how it affects the rental market because, as we know, I am a renter. I am a confirmed renter. I have no interest in buying. I like my rental, and I like renting. So it'll be interesting to me to see where rental prices end up, especially in a place where I am, where we have a whole bunch of apartments being built, and how is that going to affect the rental market for people who haven't been able to buy a house in this current housing market.
But if I said to you, like I said, we used to stand on a street corner and ask people this: are housing prices going to go up, down, or sideways, and by how much? What percent? What percent would you say they're going to go? And I'm talking about nationwide. Now, obviously, we all know that housing is local. But if you had to guess, and that's what these prognosticators do have to do. Nationally, will home prices be 5% higher, 5% lower, the same? What do you think, Miranda?
I'm going to say they're going to drop a little bit. Let's do a 1 to 3% drop.
Okay, and Mark, that's not unlike. Now you said a little more of a drop. You were talking about your specific market, but if you had to say nationally, do you think we're going to see a greater than 1 or 2% drop?
Is that for me?
Yes, that was for you.
Yeah. Yeah, everything's local. If you look at my local environment here, in 2008, 2009, I think prices went down 10% locally.
Wow,
rest of the country,
that's a lot.
you had some 40% drops, right? Because you're in a credit crunch and it's a totally different environment than what you have today. So if I'm looking locally, I think, somewhere around 5 to 7% is probably reasonable price drops. But I think there's some parts of the country, especially areas which have been overbuilt over the last, when money was free over the last, call it 5 to 7 years, where you could probably see a good 15% drop in prices.
Wow. I'm surprised you guys this is the first thing we've disagreed on. I mean, at least we're getting a spread. Pam, what do you think?
Yeah, I kind of disagree a little bit there. I think that I think housing prices are going to be stubborn. Obviously we keep saying over and over, real estate is local. So we're kind of looking around our own areas, where we are. And I too am, in Marin and San Francisco, but I'm also Cape Cod. And I'm looking at what's happening on the Cape
as a better very hoity-toity, by the way. I'm in San Francisco, and then I'm at the Cape. Oh, and then Paris.
A house on Cape Cod, though. When I'm looking at what I feel is happening is I see affordability still being a big issue. I just really feel like consumers are pretty stressed financially, and I think that if there's price adjustments, and if you're asking me, is the price going to be lower? I'm going to say I don't think it's going to be that much lower, maybe by 2% across the country as a whole. I just think prices are going to be really stubborn because when interest rates, mortgage rates are lower, and it seems like there's more affordability, there's a tight inventory. There's still fewer houses, even with what Mark's saying, where more people put their houses on the market because they are stressed out, let's say. I still think net, I think we're going to be surprised that prices are not going to do what we think they're going to do.
So is your guess zero? Or is your guess down or up? Zero?
Slightly down, maybe slightly down.
Well,
maybe down 2%.
Consistent.
All right, I love it. She's right in there with my 1 to 3% down.
Well, I hate for both of you to be wrong, but I think that's what's going to happen. But let's ask Mr. Real Estate first. Here's our real estate, not a stock guy, but a real estate guy, Aaron. Aaron, what do you think is going to happen?
Yeah, I agree. 3 to 4%. Here in our own neighborhood, we see houses that are ridiculously priced, and they're dropping like craziness. And this in Florida here, real estate's up 40%.
Oh, it's up a ton.
Yeah, it's a ton. But the influences that created that, everybody left the cities because they could remote work, and now the offices are pushing everybody back. All the CEOs going, nope, you guys got to be in the office. And so now these guys are trying to figure out new places to live. You got a ton of boomers that, are eventually going to probably, as they disappear, they're going to sell, all those houses are going to come in. We're not building homes fast enough. We've got people like me.
And we don't, and one thing, let me pop in with one thing we didn't even touch on, inflation. So, I mean, when you're factoring in the fact that we're still at above average inflation, that plays into the housing market, obviously.
Yeah, but that would increase prices. And you guys are dismal. And I'll tell you, I think I'm going to be the outlier here. I think housing prices are going to go up again. And by the way, for those of you listening, coincidentally, everybody on this podcast lives in a very, very expensive housing market. Ones that grew a ton. At least San Francisco traditionally has. I don't know about in the last year, but I live in South Florida. So does Aaron, and Idaho too. Your prices went through the roof. So we've got the United States pretty well covered here. I say housing prices are going to go up 5% next year, and I'll tell you why. I think because the lower interest rates are really going to help. I think more inventory is going to come online. And so I that these are opposite things, but I think that there's a lot of people that are. Call it a coiled spring. I think there's a lot of people that want to buy a house, and I think that they may have the opportunity to do so with lower rates. So I'm sanguine on housing prices. I think housing prices might go up a little bit. I'll say 4%.
I don't know. I don't think incomes are going up as fast as everything else is going up. So I think you're also going to see a shift of people moving out of the expensive areas and finding themselves into nice little tiny small towns and building new homes there. And you're going to see those markets increase in value while you see these ones go down.
And you also
I
have
just think
recession, the recession risk.
I think overall, though, I just think that everyone's expecting that, prices are going to come down. I just don't see it happening that as much as people think.
I'm saying they're going to go up. Well, you realize we're all going to be here again next December to see if we were right or not.
Oh, shoot.
That's what we did when Aaron and I would shoot that story. We'd go out the next year and say, here's what we said last year, and here's what these people said, and here's what the experts said.
Here's how wrong you were.
Yeah, exactly.
The monkey wrench in all of this is if Congress acts on institutional ownership of single-family homes.
Now, I didn't understand that at all.
Oh, yeah, that's a good one too, yeah.
Private equity.
Yeah, but that's actually a really small amount of homes, though.
Yeah, it's very small. What you're saying that they're going to try to prevent private equity from owning single-family homes?
There's discussions in Congress. It's kind of started, and they don't like it because obviously they're taking homes off the market from homeowners and turning them into rentals.
Yeah, I understand that, and yet I thought we still lived in a free country. I guess not, but we'll find out what happens.
Yeah, they won't create laws against HOAs.
Well, okay, you know what, guys? Before we run out of time, I promised our listeners that we would tell them how to position their long-term savings as a result of all this prognosticating we've been doing. So let's go around the horn real quick. Mark, you're our guest expert today. What should I be doing with my long-term savings?
Sure. So I'll just tell you what I'm doing with most of my clients is, we've maintained a good asset allocation strategy. So dependent upon the client's risk, if you're lower risk, you may have 50% equities, 50% bonds. My higher risk, younger clients will have 70 or 80% equities. But of that equity allocation, I've taken some of that money away and put it into more stable, protected things like gold. So I have about 5% gold in my client portfolios, and about 5 or 6% is in short-term treasuries because, short-term treasuries earning 4 to 4.5% is a great place to park some of that money and act as ballast in your portfolio. That being said, if everything we've talked about comes to fruition, you have a decent enough market where you get 4, 5, 6% return. Well, that beats your gold position, that beats your cash position. And then lastly is the bond portion of the portfolios. You've had bonds had a terrible year last year. This year, they've been relatively flat. And I think if we do get those rate cuts that we're talking about, we have a pretty good bond market coming up for us. So I've maintained a full bond allocation for clients. So it's a pretty standard allocation if you want to talk about like the 60-40 portfolio, which of course, 2 years ago, everybody was talking about how it was dead. This year, it's up 13%. It's a pretty standard allocation with the caveat of let's have a little gold in case everything goes wrong, and let's have a little cash because cash is earning us a good 4 to 4.5% without us having to do anything.
Hey, you brought up a good point, Mark, and I was going to ask you guys this. Pam did a prediction that, the market is only going to go up 5%, like what it does basically. So we have a lot of our money in high yield savings accounts. We just parked it there for safety. But as we talked about, if all the interest is going back down, I've read something about, hey, throw it all in a CD. It's up above 5.5.
You lock in rates now.
Lock it in. If you think the market's going to be topsy-turvy and you have no idea, maybe a CD is the right way to go. Is that something to consider?
Yeah, certainly. I mean, if you're looking out a year, a year is a good CD. You can get a good rate on the year long CD. The decision then is, what do I do after a year? And hopefully the market hasn't gone up 10% and I'm sitting in a 5% CD during that time. So you're playing a little bit of a game versus having the liquidity of having it in a high yield savings.
Yeah, but Mark, I'll just pop in to say this one thing. I mean, it's like the answer is, diversification wins all battles. Having enough cash for me is, it's earning enough that I can feel like I feel good about having enough money in cash. And that to me is my biggest thing for 2024.
That's your sleep at night portion of your
I don't want to be stressed out that I have too much money in the market. And even if I am giving up the gains of the market in lieu of having that safety, I just see, from where I sit, I see a lot of people that just don't have enough money really in cash.
Well, I've got boxes of 50 stacked up all over my house. What about long? I'm thinking about. You know what I did? I bought a 5-year Treasury bond a couple of months ago at 5%. Well, 4.9 something percent, and I'm really happy I bought that. I wish I'd bought more, but I'm thinking about now. I should have already bought more longer term bond funds or a bond ETF. And I have not done that, and now I'm waiting for interest rates to tick back up. Because, obviously, if you get a 1-year CD, and next year when that thing matures, interest rates are back to 2, then you're going to wish you'd gone longer than that. And I guess, obviously, you can make a ladder. You can have some stuff coming due short and some stuff coming due long. But I think that getting in some longer, or at least medium term, when I say medium term, I mean 5 to 10 year, either bonds or bond funds. I think that makes sense. Do you, Mark?
Yeah, absolutely. I have all of my clients in some form of a, SHV or 3 to 7 year treasury funds. The portions of their allocation will be in that kind of stuff. I have some longer term, corporates sitting out there, but 3 to 7 years is a pretty good, I think, sweet spot.
Sweet spot. Yeah.
I wish I'd done that a month ago, or actually just a few weeks ago. Interest rates have dropped like a rock lately. But anyway, and Miranda, let me see if I can guess what you're going to do.
Let's do this. Let's do it.
You're going to put some money in an S&P 500 index fund every month, and you're not going to worry about it.
That is correct.
We've worked together before, folks.
Yeah. I'm very boring and a very simple person. So
you are not boring.
Yeah.
That's for sure.
But no, I'm going to keep. So I have my regular dollar cost averaging plan, and I'm going to keep sticking with that dollar cost averaging plan. Now, I have done in a couple of my accounts, as we know, that I do enjoy using a bucket strategy to some degree. And so, especially for my son's 529, I've been using that bucket strategy to make sure that I move a portion of that, the portion that I think I'm going to need in the next 2 years, into cash, so that it's there, it's ready. I've captured some gains on it in that 529, but the cash is there, and I don't have to sell things at a loss if the market drops, and so to help pay for my son's school. And so I kind of use that bucket strategy to look at different things, like in my travel fund or in other areas of my life where I'm like, okay, I know I'm going to need some of this money coming up soon, so let's capture some gains. Let's move that into cash instruments, so that we can, and cash-like things, so that it's there, and I'm not selling things if I and if I do have to sell stuff at a loss later, congratulations on that tax deduction. So but yeah, so yeah, I'm pretty simple and pretty boring about stuff, and I'm gonna just I'll stick with my long-term dollar cost averaging strategy for my long-term stuff, and then I have a few accounts where I go ahead and use that bucketing strategy.
So really no change based on anything that's in the wind. Now, let's talk to Bicoastal Pam. Pam with a house in San Francisco and the Cape. What are you doing? What are you doing with your long-term savings?
My advice to myself is the same advice I would say for anybody, is diversification. I said that earlier. I say it to myself all the time. Diversification wins all battles. And I constantly remind myself to that. And asset allocation does matter. So paying attention is the perennial advice year over year over year. Especially for next year, I just feel like, who you are. Either you have enough in cash or you don't. But, don't feel like you have to move everything back into the market. Just make sure that you're really well positioned, because throughout the year, as we've talked about, the market's likely to, it's not just going to be a, straight line up, ending the year up, say 5% or whatever it's going to be. It's got to be up and down. And I just think that it's just, making sure that you've got enough money in cash is what I'm focused on for 24.
Awesome. Well, we do have to close the podcast, but I want to remind you folks that are listening that we have a consensus on almost all this stuff. So you can almost bet that is not what is going to happen. Do the opposite of what we were saying, and you'll probably be better off.
Yeah, what about the old adage, be fearful when everybody's greedy and be greedy when everybody's fearful? Is that in play right now?
I've made a lot of money doing that. Yep, it does always work. And always be in the market. When I was really afraid of the stock market in 2023. And I learned that I'm often wrong about that. So I just
you
left
have to
everything
stay
alone.
invested.
Yep.
Yeah.
Made a ton of money. Okay. We are out of time, folks, but we are never out of topic. Dig a little deeper. You're going to find links to lots more info in our show notes. And remember, if your goal is to make more, to spend less, to retire rich, well, your online home is moneytalksnews.com. And don't forget to check out Miranda's online home as well. That is Miranda Marquit, MARQUIT.com. And of course, you want to visit Pam at her website. That is wealthramp.com. And Mark, you're going to have to, it's not in my script. Tell me your website.
Yeah, you can come visit me at shorepinewealth.com.
Shorepinewealth.com.
And you'll find him on Wealth Ramp.
Yes. Listen to you, shamelessly plugging. Okay. If you've got a question, comment, or topic you'd like to suggest, tell us about it. You can email us at hello@moneytalksnews.com. And let me repeat what I said at the break. If you like us, show us. Subscribe to our podcast. Tell your friends. Really helps us. I am Stacy Johnson.
I'm Miranda Marquit.
Making it rain, Aaron Freeman.
And Pam and Mark, we sure appreciate y'all's time, and we look forward counting the minutes until you're back on our podcast again.
Thanks
for hanging out with us, everybody.
Bye,
We're going to see
guys.
you right here next time.